Alright guys, what's going on? Just give me 1 sec. Just trying to get this all up and running. Please stand by. One second, guys. Alright guys, what's going on? It looks like we only have just a few people in here right now. And by few, I mean 3. So, nevertheless, we're going to get it moving. Hopefully we could get everyone on board in regards to the actual time that we do these so that we can have more interaction, get a little bit more feedback, and answer a bit more questions. So I have a bunch of questions from responder 0. Just gonna start with these right now. Okay, so let's see. What platform can we use in the United States to short with? So currently, if you live in the United States, you are pretty limited as to what platforms you can use in regards to trading with leverage, margin, and having the overall exposure to the downside of the market with regards to being able to short it. So I am a New York resident, which pretty much makes it so that it's impossible for me to access any type of basic retail platform, all right, and use this type of functionality. I will tell you what I've heard a lot of people do, and what they do is they will use a VPN. Okay, so privacy is big in crypto, so what they will do is use an actual VPN to access one of the more popular exchanges that offer these features. All right, and I am not any type of legal counsel. All right, I don't interpret the law, all right, as a day job, but I will say that from what I've been told, there is no real ramifications for the part of the participant when using these particular avenues. Let's just put it that way. So there are plenty of options. Okay, if you do your due diligence and open up Google and see what's available, and then Google VPN, I think that you'll realize rather quickly how easy this is to access, okay, and how harmless it is, okay, for the most part, all right, for people that are actually using this as a method to short it, short anything and have access to the downside of the market. So, okay, if you would also address Level X going live, backed, and ErisX going live imminently with institutions. So, with regards to these other institutions going live, okay, so backed, Level X, ErisX, these are giving, all right, larger players access to the market. With regards to Bitcoin, okay, one of the more appealing things is having access to futures that are settled in Bitcoin. Okay, so instead of futures that are settled in cash, for example, or futures that are any futures that are not settled in Bitcoin are pretty much are exposed to settlement risk. Okay, so we know about the risks that come along with trading futures, Bitcoin futures on certain exchanges like BitMEX or Deribit or any of these futures exchanges. Okay, with these perpetual swaps where they're basically synthetic. They're not settled in Bitcoin. Okay, and what happens is the actual the underlying price of the derivative in this case, okay, is based on an index that is essentially an amalgam of multiple exchange prices. So at any given time, this is calculated from, let's say, for example, BitMEX. There are different oracles that it'll use, and the oracles are essentially spot Bitcoin prices that are used, all right? And what they'll use is a TWAP, okay, so time weighted average price, and they'll constantly calculate, all right, from these exchange prices, what the actual price will be for their derivatives exchange, okay? Now, the problem with this is that, as we've seen, all right, if any one particular larger entity has access to something like Bitstamp, for example, let's just say that they have, they're trying to, for example, short Bitcoin on high leverage on something like BitMEX, okay? Say they're trying to short it on BitMEX, okay? The BitMEX price, a large portion of it is based on the Bitstamp price, the Bitstamp spot price, so the underlying price for the asset, okay, of the derivative. All right, so what they can do is if, say, for example, we're in a period of low liquidity, okay, and they have enough capital, they could push around the price, okay, to manipulate the actual futures exchange and maybe put them in a favorable position in terms of having them be able to, in this case, if they're selling, say they sell a large market order, move the price down, affect the index, okay, and potentially reward themselves on the futures exchange, okay, with price going in their favor, and maybe them, in this case, sometimes actually manipulating price to a target, or for example, moving price down so that they can get filled before there's a reversion effect and price corrects. All right, so there is a type of manipulation that takes place, okay, and there's something called settlement risk, okay, on these exchanges that do not offer physically settled Bitcoin futures contracts, okay. Now there is currently, okay, there is Ledger X, okay, that is offering physically settled Bitcoin contracts, okay, and there also is Backed, okay, and for retail, okay, a really awesome exchange, okay, that is actually just come out, all right, is CoinFlex. So I haven't mentioned anything about this yet, okay, but CoinFlex is actually a Bitcoin futures exchange, all right, similar to the current ones that are available, but it offers physically settled futures, all right. Now, another thing CoinFlex offers is actually access to this platform right here. So this Trading Technologies platform, okay, I'm actually on my Trading Technologies account, okay, accessing my spot exchange, okay, so I'm accessing actually my Coinbase account from my Trading Technologies account. So from this exact account, I could trade futures as well. Now all I have to do is switch it out and access a different market. But trading CoinFlex actually has Trading Technologies partnered with them, and they actually use their trading interface, okay, or their platform interface on their exchange, which is awesome. Okay, you could actually, though, if you want some more, some of the features that are not actually integrated on their exchange, you could actually sign up for Trading Technologies and trade the CoinFlex exchange from your Trading Technologies platform. So you can do it either way. There's plenty of advantages to using Trading Technologies, and I wouldn't use anything else after using this. Now, I often would, I'll share charts on Twitter of TradingView charts just because it's clean. Okay, everyone recognizes everything pretty easily, but I will not really trade with a TradingView chart ever. So I will use it for the purpose of analysis. Okay, it's a nice setup. All right, everyone is familiar with it. Okay. And it is a good platform, and they will actually offer functionality in terms of having access to exchanges and being able to place orders on exchanges from TradingView's platform. So I know that's coming. Okay, that's an inevitable thing. It's been a long time in the making, and frankly I think that's great. So when these large institutions, getting back to when these large institutions come in, okay, it's important to understand that there are actually institutions in crypto right now, and I can tell you have a lot of questions, so I'm just going to get to all of them. This might be long-winded, but there's a lot of institutions actually that have been in crypto for some time. Now, it's important that we understand what type of institutions we're talking about when we are, looking for appreciation in the long term. Now, the type of institutions that are in right now are going to be your hedge funds. Okay, these are going to be your more along the lines of market makers, high frequency traders. Okay, your leverage funds, all right, that are playing both sides of the market. Really, what we want for crypto as a whole, for price appreciation over the long term, okay, to have that essentially that positive drift that we have in traditional markets, is for supply to be taken off the market. So supply gets taken off the market when we have long-only institutions come in. So there's a difference between a hedge fund and a pension fund. Okay, so your pension fund is going to be much more conservative in their approach. Okay, they're not going to operate the same way a hedge fund is for obvious reasons. They have a fiduciary responsibility towards actual pensions, for example. If you think of this, people's retirements are at stake. Okay, when they're allocating, if they're going to even allocate a very small portion to Bitcoin just for the benefit of having an access, all right, or having a uncorrelated asset in your portfolio, what they're doing is they're long only. So they're just taking supply, they're longing the asset essentially. Think about they're just hodling, okay, or holding Bitcoin. And this is taking supply off the market, putting it in a wallet, okay, reducing the overall supply in a fixed supply asset. Okay, we understand what happens with a fixed supply commodity when supply is taken off the market, okay, especially when there's a great deal of reflexivity in this asset. All right, price moves rather rapidly. So those are the kind of institutions that we want to see. We want to see long-only institutions come in, or we want to see large asset managers, okay, that are directionally biased to the upside and are not interested in, playing both sides of the market, like let's say a CTA, trend follower, for example, or a hedge fund. So that's what we're looking for. Now, would not a market dip between now and then possibly the only time frame in which to buy? Because not necessarily. So if with these larger institutions, okay, for any type of long only allocator, all right, the benefit of getting in now or getting in $1,000 from now more or less might be a rounding error when you're thinking of what their actual purpose is for getting in the first place, if they're just looking at some type of uncorrelated investment, okay, to their traditional portfolio allocation. So this is more or less to fill a requirement of a well-balanced portfolio, in the sense that we have something that doesn't respond to traditional markets, okay. It might respond to overall levels of liquidity in markets, but it is not correlated to any particular asset or any particular performance in regard to any index, okay, in traditional markets, in regards to any other commodities. Otherwise, then it might actually follow it might work the same way that gold obviously does, in the sense that it's a hedge, okay. So we have the idea of a hedge against a dystopian society. We have the idea of a hedge against inflation, okay, all these things. Importantly enough, though, okay, when it comes to hedges against inflation, we want an asset that's, increasing, and, in some cases we want something that might be paying dividends or paying interest, okay, so that we actually hedge or outperform interest rate risk, okay, or rather inflation risk. Sorry, excuse me about that. So a dip between now and then for them to get in is not necessarily, they're not, so a larger asset manager, a larger long-only institution, they might be trying to get in around something that's more along the lines of location relative to VWAP versus trying to time the market perfectly. What they're trying to do is pick up a large amount, okay, off the market without, really sending an insane signal across the charts, okay. They're trying to get in the most deft and sneaky manner. I don't want to say sneaky like it's to imply that there's like some level of surreptitiousness in the way they enter, but they don't want to really leave much of a footprint, okay, because if they're going to be putting a large amount of money into Bitcoin, let's say they're adding it to a pension fund and they're actually allocating a decent amount of money, they don't want to really convey this to the rest of the market, okay, the way that you and I want to see it, okay. They want to get in as like in terms of maybe value averaging, or the way that you might consider dollar cost averaging over a long period of time, okay, and accumulating. All right, so getting in at 10,000, getting in at 9,000, not a tremendous difference, more of a rounding error if their intention is to get in and that this is going to appreciate tremendously over the long run. So let's see, it's basically going to be hold on for dear life until exhaustion, or are they going to come in scaling in slowly? Okay, I think I addressed that. Is the futures market different? Well, the futures market is being able to place a bet on the actual underlying spot market without actually having the underlying, right? Now, the thing about the futures market, okay, is with Bitcoin, for the most part, the access that we have to the access that we have to futures. All right, so as a retail trader, you go onto an exchange and you're actually, like I said, you're not putting cash onto an exchange and trading. For example, if you're going to be trading the E-mini S&P, okay, you don't have to own E-mini S&P before you actually trade it, right? So With Bitcoin, though, we have access to these derivatives exchanges through the use of actually owning the underlying spot, in which case we actually go into the exchange and use that as initial margin before we apply leverage. But on the perpetual inverse swaps, they're inverse swaps. Okay, so when we're actually longing Bitcoin, we're shorting the dollar. So you have to think about it like that, the way that the way that it's actually structured. Okay, so with these actual futures exchanges, we're placing directional bets. Okay, if we are speculating, for example, that the price of something is going to go up over a long period of time. Okay, the access to the futures market allows us to have actual access to this upside. Okay, through the use of leverage, it allows us to have access to downside. All right, if we're in the case of shorting, all right, we don't have to own a tremendous amount of the spot to actually take advantage of this because we have access to leverage. And then it also allows us to hedge maybe our underlying spot. So maybe if you own a decent amount of underlying spot, okay, or own any spot Bitcoin, for example, and you want to actually hedge your position, you hedge it through the futures market. Now, a lot of the times in traditional markets, you can hedge with futures. They are very liquid, but a lot of the times what you'll have is in traditional markets that trading equities, for example, a lot of times you're going to be, most of this action is going to be placed around using options where you're defining your risk right away, okay? You're going to see a lot more of this insurance being used with options rather than futures. Specifically with some things over others, obviously. There are benefits to using futures over options. There are definitely benefits to using options over futures. One of the benefits of using futures over options, okay, is that with futures you don't have the same time decay, right? So you're not going to be experiencing the actual decay, okay, as time progresses. All right, for example, if you're taking directional bets and options, okay, at some point, your option, a lot of the times if you're placing large directional bets and you're out of the money, for example, and you're really just speculating, okay, your option, and a lot of the times people end up losing their entire stack, okay, and this is well before the even option expires, all right, just through the time decay alone. So options are a whole nother animal, and I would expect that as the market matures, options become more attractive. All right, right now the options market in Bitcoin is relatively small. Okay, so with the options right now, what we see in the options market for Bitcoin is a lot of near-term expiration, so a lot of short-term speculation, not much long-term speculation. Okay, so what else? Hold on one second. So the whole push, obviously, right now seems to be that we go through phases in crypto where we have all this infrastructure built around. For example, we had the ICOs, okay, and then we had the IEOs, okay, or the exchange offerings, excuse me, and then we have now we have what's growing in popularity. We have futures exchanges that are growing in popularity, and now we have their exchange tokens seem to be the hit now, and they seem to be appreciating, okay, considerably. So we have Binance Coin, now we have the FTT. The Alameda has a exchange that they opened up. I forgot the name of it. I don't think they offered physically settled Bitcoin or physically settled futures contracts. Okay. I took a look at the exchange. The platform, it seems nice. It seems a little wonky. In regards to, I couldn't really distinguish what type of features that it offered in regards to actual contingent or conditional order types. So I'm sure as time progresses, all these things are going to become far more sophisticated, though. It's more or less the fact that they'll need to actually compete. Let's see. One more thing on the Bitcoin one CME is a futures gap on July 14th between 11,000. Or was that gap covered somehow until the gap, unlike the gap at? Okay, so with that actually opening a chart and looking at that small, it looks like there's like a $400, $500 gap. I will tell you that, so on the CME, there are gaps obviously because the market closes, right? So it opens on Sunday night, closes Friday evening. Okay, so there's no trading on the CME, okay, in regards to that futures exchange for that period of time. So there's always going to be a gap. All right, so there's a few types of gaps. Okay, so there are gaps that occur between market hours. So for example, if we're talking about traditional markets, we're talking about the stock market. Okay, aftermarket. Okay, when the market is closing, all right, we will have aftermarket changes in price. Okay, but there will be a gap a lot of the times right between where price closes for one day and then opens the next. Okay, so we have this in futures as well. Okay, on the CME. All right, Bitcoin, unless it is the exact same price, okay, that it left off on Friday evening, all right, on Sunday night, it'll be at a different price, right? So this is just the gap, all right, between the time in which the futures exchange, okay, the CME was closed, all right, even though the actual underlying Bitcoin has moved. So we have to understand that the futures are actually based on the underlying spot. So the underlying spot is trading 24/7. So the gaps are not necessarily relevant in that regard. Now there are a lot of debates as to why gaps are important. Okay, as far as liquidity in that area, all right, not being tapped. What I see more often than not is yes, gaps do get filled over a period of time, but that's because markets will typically take all routes to get somewhere. So in a market that is, for example, say we have a market that is trending positively over a long period of time, is in a secular bull market, a secular trend upward rather, okay, any type of gap to the downside is going to be filled inevitably because it's a survivorship bias, right? So if we're looking at a market that has survived over a long period of time and continues to grow, all the gaps obviously did fill because the market kept going up. So this is a survivorship bias. Now, there are cases, where gaps their gaps are more likely to fill in types of gaps that are, for example, exhaustive gaps or gaps gapping up in price because, of limited liquidity or, for example, price moving rapidly and there being, a large amount of volatility, in which case we do have reversion and price comes back down and typically will fill gaps in both directions in case of moving up or moving down. The CME gaps are not what I would say are something that would give you an edge that is actionable, or rather that you should act upon and say, okay, there's a gap all the way down here and it has to fill. It just happens to be that in an asset that moves in a wide range, okay, Bitcoin has a tremendously high ATR, it has a wide range, it's a tremendously volatile asset. It doesn't just move, okay, linearly left to right from the bottom left of the screen to the top right of the screen. It tends to take all paths to get, from point A to point B. And a lot of this time, this means it does a lot of zigzagging. So I've seen people actually talk about the basis behind why gaps fill. All right, it is not something that empirical evidence stacks up behind, and you could actually say is worthy of, like I said, placing a trade around. Okay, so what else? One thing. All right. Well, I feel like I'm dominating space. Yes, you are. If you look at the DOM on BitMEX right now, it's 3-to-1 bid to ask, and it's almost 50 million to 20 million. That's great support. So yes, that is great support, right? On any exchange, all right. Think about an exchange that's not a futures exchange first. Okay, it is easier to long a market than it is to short a market. So you're a retail investor, Joe. You come into the market. What is the first thing that you can do before any levels of sophistication in regards to changing exchanges and having access to different products? The first thing that you could do is long something. Okay, so you could either place a market order to buy, or you could place a bid, all right, in the form of a limit order to buy, all right, under the market price. So that is the first area that people have access to begin with right off the bat. So that is going to, these were just some large sell orders. You see this? So we have these highlighted to show us where we are, for example, where potentially we might be hitting a major resistance. And in the case right here, you could see that something's going on. I wasn't really paying attention to it. Sorry about that. But let me exit at this real quick. So it's easier to long a market than it is to short a market. All right, so we have to think about how that actually has an effect on maybe the way that books are stacked. Okay. 2, okay, the actual depth in regards to the bids versus the offers, all right, or the ratio in terms of size between bids and offers. Okay, we are likely going to have far more people expecting lower prices at certain points than others. So it might actually be an indication of the overall sentiment. Okay, in which case we've been moving sideways for quite some time now. Okay, You can see in most order books now there is a large amount of orders placed much lower right now, anticipating a move lower. All right, and this is typical. Okay, this is what I observed more often than not. Okay, and I wouldn't say that this is necessarily actionable. All right, in saying that there's tremendous support because of the size of the bids relative to the offers. Okay, because this can change in and out. This is sometimes, like I said, this is something that is due to misdirection. In this case, I wouldn't say it is. In this case of a ratio, with that regard, all right, saying that the bid to ask is 50 million to 20 million, I would say that right now, all right, people are expecting that price might be moving sideways. All right, maybe come down a little bit. All right, and what it says to me is there are not a lot of offers on the book right now to take profit in the form of limit orders, okay, or maybe to open up shorts and not expecting higher moves yet. I wouldn't go about trying to interpret that right yet. So what I would say is that kind of comes in. That kind of is close to what I was talking about yesterday in terms of actually reading the support from the bid and the offer. All right, and we're trying to pay attention to actual solid support building in an area, okay, where we have a tremendous amount of orders starting to stack up and they're not dipping in and out, okay, flashing in and out. All right, what we want to see is, in the case of price moving down to support, we want to see that bid start to really kick up. All right, we don't want to see just one large order flashing in and out. All right, trying to really feign or convey the idea of support where it isn't really there. We want to see the bid stack up, and anyone who has an offer to be pulling that offer. All right, when we're thinking of price maybe making a short-term pop-up in this example. So I wouldn't really say, back to that question, it seems like we always have that ratio in terms of bid to offer, right? So the book always seems to be stacked that way. So, but I haven't looked into that enough, all right? So I will not say that that is necessarily 100% correct, right? So what I was posting earlier, so I posted earlier that I mentioned 2 days ago that it looked like we were going to pop up and we weren't going to be moving down yet. So we did get a pop up. All right, we did see an increase in volume, which is a good sign, right? So rather than volume continue decreasing, all right, yesterday's volume or today's volume, all right, depending on what time zone you're in, the volume for July 31st was greater than the volume of July 30th. We are still below our 20-day volume moving average, all right, and that to me, this still looks good, right? So I mentioned how, for example, we should come down and test our 100-day moving average. Okay, in relation to the fact that if we go all the way back to, just go into a larger chart just to get more price history, go into Bitstamp, and we go back to the initial trend, all right, the first bull trend, not the first one, but the most recent one. Okay, we came in contact with the 100 moving average, all right, the arithmetic mean, not the EMA. Okay, we came in contact with it a bunch of times. Now, it's important to understand that while up here, all right, we were ranging sideways for a little bit before we more or less dropped, okay, precipitously. We came into contact with this vertically, all right. We came into contact with it over here vertically, over here almost vertically before moving sideways with it. But this doesn't necessarily need to happen for us to come into contact with it. So, as all things have occurred in Bitcoin, we have to expect the unexpected, but, that comes in many forms, right? So expect the unexpected might mean, a bullish trend like this reverses halfway to the halfway point. Expect the unexpected might means that, yeah, we might mean that we came up 300%, but maybe we come back all the way down to 65 and then move sideways for 6 months. You have to be prepared for these things. Do I think those things are necessarily going to happen? No. But when I was saying how, comparing this to previous times where we touched the 100, expect the unexpected in the sense that, yeah, this trend is tremendously strong, and maybe it continues to be tremendously strong. And maybe the first interaction that we have with the 100, okay, isn't a precipitous drop, right? So if we look at where we are currently right now with the 100, okay, we are about 11% away. So if you currently own one Bitcoin, let's say at $10,000, your account right now is $10,000. Just to put that in perspective, okay, if you're long right now and you wanted to maybe use a volatility stop, okay, and you're risking 10% of your account, what that means is if it drops down and touches that 100, you've lost $1,000, right? So As a long-term investor, as a holder, as a position trader, is that how much you're willing to lose to actually see whether or not price holds it? That's a question that you have to answer on your own. Does this look? This looks to me more positive than negative right now than anything else, because we have the fact that, or we have the evidence right now that the actual 100, okay, is actually starting to really converge with price. Whereas in the past, we've kind of hit this vertically, all right? Right now, we are just moving sideways long enough that the actual moving averages are starting to catch up, which is really good, all right? Because what we have is the potential for automated trading systems, algos, okay, things that are programmed to trade systematically and robotically. We have the potential for them to actually be triggered to buy, okay, at first touch of this support as dynamic support. So this is a good thing. So moving average is going to be the moving average in this case of, let's say, the 100 periods, so the 100 days, it's on a daily. So this means that, all right, it's going to be extended from price when price is being extended, right? When price is moving up dramatically, okay, the moving average is going to lag. But when price moves sideways long enough, okay, when a tight range, the moving averages are all going to converge. So they will all flatten out and we will eventually meet them all. So this is important because if we continue to move sideways just a few more days, we'll actually be on our 100-day moving average without actually needing to have drop there. So that's my point. We will actually hit them without actually needing to drop. So this is big. If we continue to move sideways and maintain this 9,400 area, we came down to 9,100. There's no reason to think that this actually should drop anymore. Like I said, when everyone is assuming that it should drop and everyone is talking about how it has to drop, well, if it's not dropping, then who is left to sell? Right? So we have to think about that. I mentioned how everyone on Twitter thought that, and I was using that to gauge the sentiment. And someone commented, a bunch of smart traders as well, other guys who had experience in traditional markets, they commented how you can't look at CT or crypto or Twitter and consider it a barometer for the greater whole. But it's important to understand how small this market is. It's only it's a few $100 billion market cap. That's the size of a mid-cap stock. Okay, this is a very small market. So there are considerably less people actually interacting in it than any other market, all right, or in any other particular stock, for example. So when we have access to a large group of people that are trading it, we can begin to extrapolate off of their behavior, okay, and assume that they might represent a greater whole. So that's important to understand. And this is a retail-dominated asset. So if we have access to retail avenues in which there are retail traders and investors that are communicating, we have to say that it's to our benefit to, sift through this noise, obviously, and try to find the signal. But still, we have to take this, all right, with consideration. Now, BTC, Bitcoin, crypto as a whole is very sentiment-driven. So it is useful in that regard. So it looks like right now what we are actually doing, or what we initially did. So let me turn off this volume profile. Okay, what we actually did was, let me get this line. Okay, we actually bounced off the 20, so the 20 moving average. And what this is actually an important moving average because it's the center Bollinger line too. So if I take off the, let's just take off the 100. All right, let's get that out of the way. I think we're going to touch that soon. All right, take off the 10. Right now, see this 20 moving average? This is the center Bollinger line. You'll see how this lines up perfectly. When I put the Bollingers on, you won't even see the Bollinger line, or you might actually cover over it. So see this? Let me turn off log so it doesn't change the chart. Take it off, leave it on, take it off. Now if I take off the moving average, same spot. So that's actually a 20 moving average. And what these exterior lines are, okay, are multiples in regards to this moving average. So 2 times in either direction, okay, it gives you an idea of moves, all right, outside the normal standard deviation of price movement, okay, or extended beyond the mean in this case. So we use Bollinger Bands when we're trying to find trades that are, one, you could see a bullish trend in this because it spends a majority of its time on the exterior of the channel to the upside. But this is where we could see where we might actually have opportunities for reversion to the mean. So for example, when price is hugging a center line and is really extended, okay, we see that price is well extended from its average, and this gives us opportunities to potentially fade, okay, all right, with consideration that we could at any point be seeing a breakout occur, so we could test the upper channel and continue to move up. It's important to understand that. But if we're moving in a range and we're respecting this range, it gives us opportunities to fade moves in the case of opening up shorts, to long supports, okay, to long tests of this lower line, all right, with the anticipation of moving back towards the center. The idea is using this 20 moving average, okay, as a support and as a resistance, okay? Now, this 20 moving average is actually what gave us some resistance today, all right, as we came up right around this area and more or less bounced off of it, okay? Not an exact touch, but more or less. This area was a significant area in the sense that it was not only a dynamic stop in the form of the moving average, okay, that it was actually also a pretty significant structural stop. All right, now if we're going to take if we're going to apply the proper method of actually looking at this from a structural perspective, okay, we are trying to line it up first on the weekly. So if we think about the weekly open here, July 15th, the weekly close here, July 8th, okay, we could see how for this week, all right, that was the resistance. All right, this actual opening area for this week right here, go down to the daily, see where this lined up. You see how that lines up perfectly. So that lines up perfectly where we rejected off of here as well. So I'll make this line actually a little bit darker so you can see. So you see how this area, okay, two factors lined up. All right, so we had the structural area in terms of structural resistance, all right, which is likely to have serve its purpose from the perspective of longs who are longing and placing targets to exit at this point, shorts who are looking to open up shorts. So we have two forms of sellers right there alone, okay, and anticipating the retest of this 20. So if we have anyone who's following the trend, all right, or trending or trading mean reversion in this case, okay, they're going to be looking to sell this touch of the 20. So for example, we have the structural support and the dynamic structural resistance and the dynamic resistance in the same exact area, more or less. So what I want to see, okay, and this is perfect that they line up like this, is in this case what I would want to see, all right, to assume that we were going to resume a bullish trend. All right, you don't want too much confirmation, because when you ask for too much confirmation, all right, you have to assume that the more confirmation you're looking for, okay, so for example, we're waiting for this confirmation break, okay, we already have the meat of this behind us. All right, what we want, or what I want, what I'm looking for is an actual break of this area, okay, 10,200, okay, in which case we close above this structural resistance, turn it into support, and close above the 20 moving average, okay, at which case I would say the next target, okay, the ideal next target is this area right here, okay, so right here, in which case 10,800 or 11,000 if you think of that, you know, more or less where if we're looking at wicks, if we're looking at actual candle bodies. All right, we'll see how this lines up on the weekly. Okay, if we want to actually go into, just put this back on. Okay, we could say that this is likely to be an area where the highs are of here. All right, and then if we open up our Bollingers, to assume that if anyone is trading using this method, all right, if we're going on to the daily, finding resistance at the 20, okay, what we would be seeing is we'd see a little bit of take profit at this area, okay, if we're considering it here or here, depending on how you're actually drawing your lines. All right, considering that this is likely to be an area of take profit and how we are pretty close at this point, all right, to the exterior of this Bollinger Band. All right, so at that point, what you're going to have two different types of traders doing is, one, trading the pullback here, looking to long the support down here, and two, trading the pullback here, looking to long this 20 moving average in this case. All right, so if we move sideways, it'll probably look something like this, in which case we're going to be looking for that dynamic support, and we're going to be looking for that structural support right over here. So that's what I'd be looking for. I'm looking for the 10,200 area to be closed over, all right? And we want to see this consistent increase in volume overall. Now, just a little quick lesson on how support and resistance functions, because I see a lot of traders that are purists in regards to price action trading. Okay, all they do is draw levels. I really think that they do an incredible job, okay? When you really fine-tune a method, okay, it's like nuances and a little idiosyncrasies in regards to price movement. Okay, you just get better at doing something that you do often, right? But what I see is more often than not, okay, these areas just be trading, okay, in a very binary. If it hits that, then this way. So trading is in crypto is very deterministic. Okay, there is a strong argument made for the whole concept of if we break this, then this next. It is important to understand though that this is not a given, right? So we have to look into each trade as, even if it is through the same structural area, as having different probabilities based on the actual context of the situation, surrounding environment, trading environment, and what have you. Now, I think that the best thing that you can do, okay, from someone who's traded futures, from someone who's traded equities, not trading equities the same way, but from someone who has experience in multiple markets, all right, from I would say a point of authority is to take more into consideration than just support and resistance, all right, just the purest form of support and resistance and price action trading. Now, I would equate this to still bringing a bow and arrow to a smart missile fight. Okay, what you're doing is you're really limiting yourself. What you should be doing is you should be applying these same structural based trading methods, support and resistance, order blocks, and so forth, with the use of the DOM. So you should be using the DOM in this case. You should be using some type of tape reading methodology to interpret whether or not, okay, these areas actually have merit to them, in the form of how buyers and sellers are reacting around these areas. So that's really important, okay? Very important than actually just looking at the trading view, for example, and seeing how price action is responding. You get a better idea, I think, when you're actually looking at the tape and you're looking at actual order flow, okay? And actual order flow. I'm not talking about just the commonly overused term of order flow, just like the overused term of market maker, okay? We'll do a whole video on market making, okay? Good friend of mine is actually a huge market maker with futures in pretty much every market. And market makers are pretty much delta neutral. So they're pretty much directionally agnostic. Actually, what they don't want is any type of major toxicity in the form of informed traders. They want stupid order flow. They don't want anything that's crazy, right? So directionally agnostic for the most part, delta neutral. The idea of market making is a risk-free trade, although we know that doesn't exist. So getting back to what I was talking about, okay, what was I talking about? I was talking about support and resistance and how it's better interpreted with actual interpretation of the DOM or reading the tape. So where were we? Okay, so how support and resistance actually works and the dynamics that we have to think of that occur at these areas. So say we are, for example, pinging between this area. All right, we pinged off of here. What happens after let's just say for the first time, after we've retested this support? Okay, we've retested this support. This is an attractive long area for anyone who's entering into the trend late, looking to enter into a long with anticipation of maybe cashing out here to some degree, right? So what happens for anyone who is not in this currently? All right, so not paying attention up here. All right, anyone who's not in this currently, okay, likely has their limit orders placed to be filled down here. So price moves down, it experiences a little bit of a spring. Anyone who does not have limit orders, okay, to buy at this point might actually just jump the queue, forget the actual wait, all right, and guarantee their entrance by actually taking liquidity and using an actual market order to actually hit the offer. So we have a spring, right? We have a spring, okay? Anyone who was prematurely trying to short the break of this, okay, opens a short right here, price moves against them, they're immediately underwater. So what do? They likely are going to close out their position at some point. Okay, price is going to move up because what are closing shorts? They are buyers. So price moves up, okay? At this point, all right, we are passing for a long the optimal area for, good risk and reward. So we're closing towards the actual resistance. Okay, at this point, what are you going to have? You're going to actually have traders that are looking to likely sell, open up shorts, so you have some type of downside momentum. So you have orders that are placed here to actually sell, all right? You have orders that are sideline traders are looking to short, okay, at market. Okay, so we're providing that resistance. So this is the dynamic of support and resistance, right? So what happens when an actual area breaks? So let's just say we're moving through an area. Okay, what do we have right here? We have a potential breakout setting up. Okay, so there are some traders that are going to long this breakout before it actually occurs. So price is going to pop up, right? So price pops up. At this point, any type of short looking to catch a wick, catches a wick maybe, right? Move back down. Okay, let's just all this acting like this is natural. Price moves back up again. So at this point, price moves back up. All right, we have traders that are entering in on a breakout. All right, at market. Okay, let's say they have stop triggers up here to long this breakout. At this point, shorts are underwater. So shorts are upside momentum. Okay, At this point, though, they have still longs that are still long from down here that are likely to pull back, okay, exit, and then we also have more shorts that are likely trying to take the extreme end of this. All right, so we have a little bit of downside momentum, okay? So the shorts that were in here that likely covered underwater, they help us with this initial pop. As price moves back down, though, okay, this is looking like it's setting up to be a retest of a support and resistance flip. So we have the longs, again, limit orders right here, market orders right here. At this point, the downside momentum shifts to upside momentum also, again, with the shorts that are looking to exit because now they're at break even. The trade moved against them. They're coming back down. Breather, break even again. They exit. They actually manifest this process. So who wins in this whole process? It is the side that has more gunpowder, obviously. All right, the side that has more gunpowder, the side that is looking to give up. So this is how support and resistance dynamics play out, okay? Supports can be psychological, okay, in the form of supports that are, for example, maybe they have been established, or supports and resistance that have been established, okay, a considerable amount of time from where we currently are. So they will serve as maybe a psychological barrier or support. And then they're technical, where we're actually going to have resting limit orders, okay, resting limit orders that are placed to actually provide support or provide resistance in the form of buyers and sellers, or in some cases buy breakouts, okay, in either direction. And this is why we always say that it's important to wait for confirmation. So confirmation might come in the form of looking at a 4-hour candle close versus a 5, because, for example, a lot of times traders will be on the lower time frames and they will experience the wrong side, the adverse side of what we see right here, which is we have a breakthrough in actual area, but we come back down, right? So what we need to see, and this is why it's better to trade on the higher time frame, all right? If we're not trying to scalp a range and stay committed to being between an actual range, the higher time frame trades are better for our swing traders, our position traders who are looking for longs, okay, with a considerably better risk and reward, all right? These type of traders might have a lower hit rate, okay, or a lower win rate, for example. Maybe they only win 30% of their trades, maybe they only win 25%, but what they're looking for is that, 4-to-1, okay, 5-to-1, 10-to-1, 20-to-1 setup. Who knows what their expectancy is? All right, maybe their expectancy is 3, 4, 5, all right, 10 if they're a god. But what they're looking for is they're looking for on the higher time frame, okay, that we come up, close, and we have a strong 4-hour close, for example, above a major area of support and resistance, or rather that was a major area of resistance and has been flipped into support. Okay, and this works, again, because of behavior, human behavior. All right, a lot of the times human behavior that act around actual technicals, right? And we all see this occurring. So when market looks strong, we're willing to enter into a strong market, and we actually end up being the fuel that actually propels price higher. So we could do a whole video on behavioral economics and behavioral finance and all these things at play. I think it's really important that you study behavioral psychology if you really want to improve your ability to control your own self. That's tremendous. So so that's support and resistance. But what I did want to finish up with was how it is important to adapt to different market conditions, right? So changing market conditions, all right? And you could look at changing market conditions. Okay, let me just open this up real quick. So we have a few things that I put up here right now. So this is in RSI. Okay, so this measures the change in regards to upward movement versus downward movement. All right, it's a calculation I don't remember off the top of my head. But what we're seeing right now is it is actually holding what is a important area. Okay, so it's the 40 to 50 zone right in the middle. Okay, holding that, the moving average crossover. Okay, moving average convergence divergence, in which we have a 26 and a 12. Okay, so the difference between that with a 9 moving average placed above that, okay, or over that. All right, this is a really good momentum tool that traders will use. What we're seeing is we're closing, or we're rather from the underside or from below, we're actually starting to show a potential move to the upside and shift in momentum. All right, so that's what this histogram is actually showing. It's showing the actual convergence and divergence between these lines. All right, so that is the MACD and the actual signal line. So this is starting to look bullish if we have a green right here. Okay, if we're looking at that from a trend following perspective or momentum trading perspective. Okay, what we have right here is the average true range. All right, so if I'm looking at how market conditions are changing, I'm going to be looking at market structure. I'm looking at the ATR. I'm looking at levels of volatility. So when we go from, for example, okay, what I will use is, in this case, when we go from a period of moving above the 20 moving average to being below it, okay, I will shift the way that I'm actually trading from trend following to preparing to trade a range and preparing to trade chop. So in the case of a really bullish trend, if we're, for example, really bullish and we are extended even over our shorter moving averages like the 10 or the 5 in some cases, if you're extended above the 5 for a prolonged period of time, at some point you should be fading that trend. And I don't say that as a something that you have to follow, but if you're extended over the 5 moving average, okay, there's a good chance that mean reversion will arrive shortly. And there's actually a whole method that we could use the moving average rather on a 5-minute chart to actually trade price action, okay, in regards to how far we are extended from 5 or a 10 moving average. Again, the moving average, not the EMA, not the exponential moving average. So when we actually go from being above these moving averages to being below them, okay, I will shift my trading methods to following the trend, okay, at a rapid pace, okay, so using some of the moving averages to enter and exit based on compression, based on market structure, okay, based on breakouts, to looking at a more controlled range-bound trading method, in which I might be using something like the RSI to try to find potential turning points. I will use a lot of just support and resistance trading, all right, and I am still thinking within these bounds until we actually have a shift in this higher time frame trend and I actually have a signal that the trend has changed. So the way that I actually trade the market is going to be tailored to the overall market conditions, right? So I'm looking at what is the overall levels of volatility. Okay, are we in a clear uptrend? Are we in a sideways trend? And I have to be able to adapt right away so that I could take the most out of the market and have the market take the least amount out of me. So we have to be willing to recognize things for what they are. All right, and we have to be willing to, or rather we have to be adept at seeing these shifts, all right, as soon as possible. Now the problem is the signals for the shifts, okay, we don't know whether or not they're actual shifts until a good amount of time has actually expired. And that's just the case with all things in the market, all right? There's no perfect signal for when something begins or ends, all right? What we're trying to do is build a case around this as best we can, right? Not really the best idea to anticipate this before you get any kind of level of feedback from the charts, though. So that's that. All right. Hopefully that was informative. If anyone has any questions, I actually can't see how many people are actually watching this right now. It says a few earlier. If anyone has any questions, feel free to ask right now. The floor is yours, more or less, and I will be glad to answer them. If you don't have any right now, and you watch this video after it is aired, okay, or after it is listed, feel free to, message me or Josh and ask us any one of these questions you have. So I'll leave it open for a sec. I'm going to go grab myself a glass of water, and I'll be right back with you in a minute or two. All right, so it looks like we have no questions. And in that case, I'm trying to think if there's anything else that I think is important to cover. All right, let's take one more look at everything. All right. Let's see what we have. Where is the volume? Now, this move up looks to be, while we are finding considerable resistance above overhead. All right, the one thing that's nice about this move right here is you can see that this is an impulsive corrective move. What it looks like is just a corrective rebound. You have the decreasing volume. All right, as price moves up, volume is decreasing. All right, this is one move up here where we're actually on increasing volume. Okay, again here though, these moves up, decreasing volume. Okay, up, decreasing volume. All right, this move though, we have a small amount of volume behind it, but nevertheless it is increasing, which is favorable in regards to the actual trend. So if we're looking for the beginning of a trend up again, or beginning of a move up again, we want to see that volume behind the actual price. Thanks, Ryan. So much kudos. No problem. Responder 0. Adam and Eve. What do you think is an Adam and Eve? What do you think Adam and Eve is? Do you think this is an Adam and Eve? No. Well, Adam... I don't really get too much into the whole naming of things. It's just behavior behind the actual people trading. We have 2 major rejections up here. If maybe you're talking about this. Well, technically, pattern like this would be at a bottom, right? We would have like a V bottom and then a rounded bottom, right? So the splash and then the slow grind consolidation, if that's what you're talking about. I don't know if the V bottom and then the U bottom. Yeah, but this is typically going to be found at the bottom of moves. So we were looking for that down here. So this is more along the lines of that. Okay. So this is pretty textbook. All right. It's funny because a lot of people they'll quote textbooks and Bitcoin actual price action and it seems almost too good to be true, but we just have to imagine that this is just any other asset. This is like any other asset where there's a trend, there's a large amount of people acting the same way people do, trading it. So these type of patterns do exist. We have to be careful though with patterns because people have a tendency to see them where they don't exist. It's like sort of seeing elephants in the clouds. But this is not just clouds right now. This is not just water vapor. This is actual buyers and sellers. But patterns like that are typically going to be found at the bottom, not in the form of continuation. So typically, so a lot of times people will be talking about cup and handles, and let's say, oh, cup and handle. Now, cup and handle is actually a textbook. It should be considered a continuation pattern. So it should be cup, handle, and a move up again after a break of this line. So the point is it's continuation after a move up. A lot of times what you'll see is people talk about cup and handles after a major move down in a market. Okay. All right, after we came from above, which is not technically correct. Technically, the cup and handle pattern should be like that. Now, Adam and Eve pattern should be the same way in the sense that it has definable characteristics. Yes, it has a certain shape, but Adam and Eve should come from this way and not from being rejected after after a move up. So that is not in Adam and Eve. And Adam and Eve is after we've come down and we've splashed and then done that and then changed direction. So it's a major bottoming pattern, not a continuation pattern. So, but I mean, how much actual consideration do you want to give to patterns, right? When we think about the way that a chart is structured, all these bars kind of look the same. We have fractals within fractals as it appears. So it's really easy, again, to start seeing things where they don't necessarily exist. So not to say that there's no action that can be taken or consideration that should be placed when we do notice things. Like, for example, when we see the price is really broken out and it's flagging, this is one of the, if we're looking at just patterns, for example, there's a whole book on patterns and how, their probabilities and their expectancies in regards to how successful they are after, a certain amount of time and so forth. And what you'll see is a lot of patterns are actually, sometimes they're just 50-50, right? But there are certain patterns that are definitely way more, they have a higher hit rate than others. And I believe that the biggest one is some type of flag pattern. So a flag pattern, for example, like this, okay, is very strong because the resistance, while remaining the same, okay, it's being bought up with each successive move up. Okay, whereas flag pattern like this shows a little bit more equilibrium between buyers and sellers. Okay, bullish still, but we could still have that potential for it to break down. I mean, we could have a potential for anything to break down, but there are different ways to interpret them and rate them based on how strong they are across other markets as well. So You don't see a lot of pattern trading in equities. You do see it on maybe the smaller cap stuff. People are trading, penny stocks, for example. What you will see in equities is larger patterns referred to on the high time frame. So you might see, head and shoulders referred to. But what you often see in equities is you'll see head and shoulders painted for so long, and then it just doesn't go according to plan, and it's redrawn constantly. But you see that in crypto too, right? So understood very much. Thank you. You're welcome. Responder 0. What's your name? How about that? This way, whenever I talk to you, I'll respond to you by your name. My name is Ryan. Everyone calls me Clark, but that's because Cantering Clark. Clark is the horse. Clark is a horse. Clark is a horse. Journey's a horse. Simba's a horse. I have a few horses, so I named I named my company after one of my horses. Well, I don't know why I chose that one. Well, Clark's good, but so yeah, that's pretty much that, guys. If you have any questions, always feel free to Jerry. Nice to meet you, Jerry, with a G. Feel free to direct message. I'm gonna be posting this video so everyone else can watch it. Looks like we have a little bit of action going on right now. I see price flashing. Oh, let's look at this real quick. This unbelievable 1 second chart that they have. Unbelievable. So TradingView actually listed this 1 second chart, which is, like I said, unbelievable. But it's interesting because there are tick charts that are really useful. So tick charts are actually really useful. Now, 1 second charts, 5 second charts, I think that people are going to be spending too much time on these in crypto and wrecking themselves even more than they already are. So that's that, guys. Hopefully that was informative. Thank you for tuning in. All right. Thank you for tuning in, Jerry. I look forward to doing this again. So, as always, guys, this is Ryan with Block Roots. Exercise proper risk management and trade effectively. Have a good night, guys.